What's up, guys? Michael Key, and today I think I'm going to piggyback off of some of the content in my video yesterday. And yesterday I discussed selling put options and how they can statistically increase your chances of profit in the short term, but also how they can help you build a long-term position in the market. And today I want to just throw some numbers at you. And those numbers just show the differences of maintaining a short-term position versus a long-term position. And we all know people, and you may be one of them, that like to play the lottery. You'll go and you'll spend, your $2 every week, however often it is, with the hopes of just winning a huge fortune. And we all know the statistics with the lottery are extremely, extremely low. The chances of it happening are you can guarantee almost never. But we all run on hope. And when you're looking at, let's say, gambling, so I like to play blackjack. I like blackjack because, we all like winning money, but statistically, it's a game that you have the best odds in the casino. But also you can play certain strategies and, do some card counting, and it doesn't give you odds over the house, but it increases your odds, what I would consider substantially, but not in terms of, actual winning percentage. No matter what you do, the house is always going to be the favorite. And the reason being is because of the rules of the game, and any casino game for that matter. In blackjack, if you play basic strategy, I believe the odds of winning a hand is like 42%. Maybe a little more than that. The odds of having a tie, which means you don't lose any money, you just break even, are like a little bit over 8%. And the odds of losing a hand is almost 50%. So you would think that since you're only playing against the dealer, and the dealer somewhat abides by the same rules the player does, that it would give you almost a 50-50 chance of winning. But the difference is that when the dealer loses, or if the player busts and loses, but the dealer busts right afterwards, even though that results in a tie, the player still loses because they lose their money, because they busted first. So that's where the advantage starts to come in over the player, is not from a win-loss percentage, but a money win-loss percentage. And with the market, if you take that into consideration, you start to realize why longer-term investing is the way to go. So you have what's called unrealized gains and realized gains. Unrealized gains are basically exactly what they sound like, which means you buy into an investment, you see that investment, the value of it up from where you purchased it, so you see that you now have more money, but you still own the investment, and it still fluctuates in value along with the investment. Your money does. So, yeah, on paper, you're worth more, but it's not real. A realized gain means that you buy that investment, you have the increase in value, and then you close out that investment. You sell it, and you turn it back into cash. Now you have made those gains real. You've realized it. There's a reason why unrealized gains aren't taxed, but realized gains are. So when you put that in perspective, in a game of blackjack, after every game, you have realized gains or losses. And going back to the taxation, that's also why you can't deduct unrealized losses on your taxes. But you can deduct so much of, a certain amount of your actual realized losses. So every game of blackjack, there are realized gains and losses or break even. But they're realized because the game's over. Every hand. And I went through the internet and tried to find out the statistics of positive returns in the S&P 500. And I found a pretty good analysis by Fisher Investments here. Now, this ended, their study ended in December 31st, 2017. So, it's a few years old, but the data started back in 1928, so before the Great Depression. And what they found was, if you looked at daily returns for the S&P 500, so if it went positive or negative every single day that it traded, that over a period of a month, you had the daily returns, for the S&P 500, total through this period of 1/31/1928 and 12/31/2017, you had 53.1% of the time the S&P finished positive. And 46.9% of the time, it finished negative. So, the amount of days they have here is positive 12,343 days, positive negative 10,916 days, for a total of 23,259 days that they look back at. Quarterly returns, so calendar month returns. So this is how many months were positive or negative in the S&P 500 throughout this time. So what we just looked at was the daily returns. It was 53.1% chance that you were going to end positive. Now, if you extend it out to a 1 month, there was a 62.8% chance that the S&P finished positive for the month. If you extend it out quarterly, so for every quarter during this period, it was a 68.8% chance that the S&P finished positive for the quarter. And then yearly, when you extend it out for 1 year, over a period of 92 years, 73.9% of the time, the S&P 500 finished positive. There were 68 positive years and 24 negative years. So, there's literally a linear relationship on time and success, or probability of success, when it comes to investing in the S&P 500. And the reason why I use the S&P 500 is because it's collectively, diversified, but it's, the largest 500 companies that are publicly traded in the United States. And it's, a lot of people look at the Dow the Dow fell however many points today. Generally, the S&P 500 is the benchmark used when comparing equity investments. So, the next line of data they looked at were rolling 1 year returns. So, rolling returns. So, and it's month to month. And what that means is they went back and said at any combination, basically, on a rolling scale, so January to January, then February to February, then March to March, every year during this data. So it's basically like if you're saying, okay, what's the average annual return for the S&P 500, and they got 68 years were positive and 73.9%. They're looking at generally, I think, January to January. And you can have, like last year with COVID, we were at all-time highs in January. And the market finished, by the next January, let's say, or the start of this year, was up. I don't even know what the percentage was, 30%. But if you looked at March of last year to March of this year, it would be substantially larger returns, right? Because you have a lot that goes on during the year that doesn't show on the average annual returns because it recovered during that year, and vice versa. So they looked at the rolling one-year returns, which I think would be more, if I was going to invest, I'd look at that number. That'd be more, trying to think of the word to use, but that I think I'd rather see that number than what the average annual returns are. But for rolling one-year returns monthly, month to month, they had 1,093 periods. And 74.7% of the time, the S&P finished positive. So 816 times it was positive out of the 1,093 times. 74.7%. Which is higher than if you just went back and looked at the average annual returns, that on the amount of times that was positive at 73.9%. For the rolling 5-year returns, again, looking month to month. So they're taking a period of 5 years. The S&P finished positive 87.5% of the time. On a rolling 10-year return, this is where it gets interesting. On a rolling 10-year return, month to month, the S&P 500 finished positive 94.1% of the time. 94.1%. On a rolling 20-year return, month to month. So that's cutting out any 20-year period that falls inside of 1/31/1928 and 12/31/2017. The S&P 500 finished positive 100% of the time. And on a rolling 25-year period, the same thing, 100% of the time. So, put this into perspective. You're a young person, and you're worried about investing. And you're worried about risk, or you're not sure how it works, or you're not comfortable with it. You're just for whatever reason fearful. In the S&P 500, you can go buy mutual funds that track. You can go buy ETFs, and I'm not recommending the S&P 500. I'm simply using it because that's the benchmark that is used most frequently, and it's just an easy way to invest in the market and a good tracker of it. But if you're a young person, my age, 28 years old, and let's say you are thinking about starting a retirement account, and the reason why I say that is because an IRA, Roth IRA, 401k, whatever, you can't touch it till you're 59 and a half right now without getting penalized. So you have about a 20-year time horizon at 28 years old. 30-year time horizon at 28 years old, which is more than all of these rolling periods. So past performance is not indicative of future returns, anything can happen. But if you did look back at the past and saw that, okay, in a rolling 20-year period, going back almost 100 years now, the S&P was positive 100% of the time. You could say to yourself, well, if I do invest, I know at least I'll have the money that I put in there. Again, nothing's a guarantee, but that just looking back at that figure, that's what you can see. And then once you see that, think about, well, what's the trade-off? What else are you going to do with that money? Spend it? Putting in a savings account? What this doesn't show is on those rolling periods, yeah, it's showing how many times it finished positive, but how much positive, right? You know, was it 5%, 10%, whatever. If you look at the average annual returns for the S&P, you know, you'll get a few different numbers, but I think it's a little over 10% when you count reinvestment of dividends. So, if you look back at like a savings account and the interest rates you're going to receive in savings accounts, you're far better off investing in the S&P 500. So, imagine if these lottery players playing the odds in the lottery just invested their money in the stock market. And what's even funnier is that some of the people that buy lottery tickets don't invest in the stock market because of how risky it is. But they have almost a 100% chance of losing the money that they're using to buy the lottery ticket. So, what would make the lottery more attractive would be if you bought your $2 lottery ticket and they chose the winners that week, but there were no winners, so they refunded your money. And again, going back to blackjack, that's the other reason, that was the reason why the odds aren't just 50-50 odds, because when there's a tie, you're not getting your money, or you are getting your money back on a tie, but if you bust before the dealer busts on the tie, they're taking your money before they bust anyway. So you're losing money on certain tie situations. But also, your chances of winning are lower than the dealer has anyway to start with. But, you know, so yeah, if you bought a lottery ticket and if there was no winner chosen for that week, they just refunded the money. You didn't get any more or any less. You just got your $2 back, so the next week you can go buy another ticket. And if you even look back at that situation, that how many times did they not come out with a winner immediately? I don't know what those odds are. I don't know how often that happens. I know it does happen, and that's why the lottery will jump up every week or so. But that would make it more reasonable. But you don't. You lose your money. As soon as $2, no matter what, you're going to be at a loss of $2. Even if you win the lottery, you're going to get your lottery winnings minus the $2 ticket you bought. So the difference with that in investing in the stock market is the unrealized and realized returns. Because you can buy in to an investment, let's say the S&P 500, the only time period is your own personal time horizon. You can play the game and remain in the game as long as your time horizon fits it. And when I say time horizon, I brought up the retirement account. I'm 28. If I have a retirement account that I can't touch till 59 and a half. And if I don't, sometimes if you don't need the money in retirement, you don't have to touch it till 72 now. You know, we're getting into a different discussion there, but let's say that's a 30-year time period that I can hold the money in before I need to use it. I can buy into that investment and just let it ride. Even though I'm down, I can sit in it and remain in the game until it comes back and wins. You can't do that out in anything else. So, when you look at like day traders who are buying and selling all day long, and they're going to close out all of their positions by the end of the day because they don't want to hold them overnight, they are realizing all of their gains and their losses. Which means that if they're down at the end of the day, they're down. And if you're investing long term, you can be down in a month from now, you can be down in a year from now, but based off the statistical probabilities of the S&P 500, once you get out, you're going to have an 87.5% chance in any 5-year period of being positive. You're going to have a 94% chance in any 10-year period being positive, and 100% chance almost. I can't say guaranteed, but based off of past statistics, 100% chance in any 20 plus year period of being positive, of winning. So yeah, simply from a win-loss perspective, investing in the S&P 500 is far better than any sports bet you're going to place, than any casino game you're going to play, and any lottery you're going to play. It's actually better than any kind of game that has two sides of it that can win money, where there's a winner and a loser. Because any game that has two sides, no matter how favored one side is, like if Alabama's playing a high school team next week in football, yes, they're heavily favored, but there's always a chance, right? And there is with the market, but going back in history, Alabama has gotten beaten by, slaw Division I AA schools a lot more over the last 20 years than the S&P has finished positive on any 20-year rolling period. So put that into perspective, because a lot of people would go and place a bet on Alabama playing Citadel, right? Because the odds are just, in fact, the bookies, the online bookies, will have, where you can't even put up just a straight bet, a win-loss bet on Alabama or the 1AA school, because of how in favor the odds are. But if you look back to the last 20 years or more, Alabama has probably lost to more Division I AA schools or low-end 1A schools. So, I think their last small loss would have been ULM, Nick Saban's first year. Nick Saban hadn't been there for 20 years yet. And so, yeah, you just got to put that into consideration. And a lot of people would go and place that bet on Alabama if they could. If Alabama was playing, some D3 school tomorrow, and you were allowed to bet on it, you would go put all of your money on Alabama with all the information known, but people are worried about investing long-term in the stock market. And the stock market has shown far better results statistically than the other scenario. So, it's not necessarily about understanding the inner workings of the stock market, but it is about understanding the risk and reward of what you're doing. The other thing is that you get to choose the amount that you invest. If you wanted to go play the lottery, they set the price for you. $2 a ticket, $3 a ticket, whatever it is. You want to go play blackjack, it's $10 a hand. It's $100 a hand at this table. If you want to go and play, if you want to go put the bet down on Alabama, with 5,000 to 1 odds, okay, you got to place a $5,000 bet to get your $1. And some online bookies would have a minimum, you have to risk before you get a certain payout. So they set the losses. When you're investing your money, you choose how much you want to invest. If you want to invest $1, go invest $1. There's a lot of brokerages now that offer minimum or share slices. So you can actually go and invest in stock slices, individual stock companies in stock. Sorry, individual stocks in these companies, like a Google or something like that, and buy actual slices of the shares. So you don't have to go and buy, $2,300 worth of a Google stock or $3,000 Amazon stock. You can buy $10 of it and have a piece of it. You can invest in a mutual fund, maybe that has no minimum, and buy partial shares so you can do a $10 investment. These are all accessible. And if you look back at the chances of winning, I mean, that's just a smart money move, it seems like. So, there's something else that can add on to that. But I thought that was pretty cool. I thought that was a good visual, and I can try and put this link. I got to be careful on what I'm adding, as far as like material, and but this is online. If you just look up, what I look up? I looked up, let's see, how many positive years has the S&P 500 had on Google, and I found that. It was a PDF form. So the other thing that can help increase your chances is what's called dollar cost averaging. And what dollar cost averaging is it's a way of lowering your cost basis into your investment. And there's two different kinds or ways to go about dollar cost averaging. If you're someone who's like an active trader, you can, you let's say you had $1,000 in cash. Here, and I'll draw it out here. Let's say you had $1,000, and you're going to buy a $100 share. Of whatever. That leaves you with $900 cash and one share. If that share declines to $90, let's say, you would purchase another share out of your $900. So that leaves you with $910. Sorry, $810 in cash. And now you have two shares. And your average cost basis of these shares would be $95 a share. So if you only bought one share at 100 and you were just going to hold it, and the stock went to 90, it has to make back that $10 for you to break even, and then has to go back above $100, for you to be positive. Well, if you buy shares when you go down, you do the same amount of money, so you're going to invest. Well, I'll get back into that one in a second. But basically, as it goes down, you're going to buy shares at cheaper prices. That's going to lower your overall cost per share, and your investment doesn't have to work as hard on the upside for you to get back to even and then have gains. And you do that because you're using statistical probability of your investment. That's why the S&P is a good one to look at. Like if you're doing this with the S&P, you're going to use statistical probability that the S&P over a long period of time is going to return to positive. So when it's going down, you're just buying those shares at a discount. No different than you going to the store and buying things because they're on sale. But this one is actually going to give you a return, hopefully, in the future. So that's a way to do it when you're actively trading. And just, on negative days, you're just going to buy shares. The other way to do it, and it's basically the same concept, it's just slightly different, is instead of just buying like a full share, you can do it. This is how it's done in most of your, if you have a 401k or if you own mutual funds, you would do this if you're paying in monthly. So let's say you're just investing like $100 a month. Well, like I said, mutual funds, and now with certain brokerages, you can buy stock slices. You can actually invest equal amounts of money over, monthly or yearly or however you want to do it, and it doesn't matter because you can buy however many shares that will get you. So again, with the same concept, you're doing $100 a month, and let's say that gets you one share this month. The next month, you do another $100, but that one share went from being $100 to $90, right? So that $100 would buy you, let me do the math here on my calculator. $1.05 shares. And for the people that were able to do that in their head, good for you. But that $100 would buy you 1.05 shares. So now you have a total of 2.05 shares for $200. The next month you do the same thing, $100. And the investment keeps declining. And it goes down to $80, has a big dip. It goes down to $80 a share. That $100 will buy you 1.25 shares in the third month. So now you would have 3.3 shares after 3 months because you're able to buy more shares with the same amount of money at discounts. That also means that to get back to the original $100 share value, so you bought at 95, then you bought at 205. What you would do is you'd divide that by the total amount of money you've paid, which was $300. So you have 300 divided by 3.3 equals a cost basis of $90.91. Oh, excuse my handwriting. I'll write it clearer. So you have a cost basis of $90.91 a share now. Which means that when it goes down to 80 and you've been lowering your cost basis, it doesn't have to work as hard to get back to where it was. You'll get and when it does get back to where it was at $100 a share, you would actually have $30 in interest that you made, which is a 10% gain on your money. So, investment. So that's something to think about on why you should dollar cost average. And that allows you to take even more advantage and put not just odds that are in your favor when it comes to investing for the long term, but to really maximize the odds. And you don't even have to get back to even because you're increasing your chances of winning. Because if 100% of the time, over 20 years, let's say, the S&P finished positive, which means it's going to finish above where your initial investment was at, and you've been dollar cost averaging down, then you're actually going to have far better returns than you would just holding. Now, that works both ways, right? If the investment is going up and you're doing $100 a share or $100 a month, you buy less than a share. And, that will kind of even out, but that's just the concept of it, because over time, as the investment grows and you're only doing $100 a month, you're buying less and less and less shares. But on the days that it's down, you're buying more shares. So it kind of evens itself out a little bit, but you're never putting in more than that $100 a month. And you're just taking full advantage of the probabilities and playing with the investment. So again, I just wanted to offer that perspective. And then, going back to what I said yesterday with the put options, you're utilizing the puts to get paid off the premium you're selling the puts for, but allowing you to then, when the stock does have a big decline, you're purchasing the shares far lower. So you're taking even more advantage by buying in on these dips and getting the upside. And you would just do it on good investments that you want to hold for a long period of time. This is also why, like Dave Ramsey he tells you to invest in the mutual funds, because it's managed and you can hold them longer. You don't, and when you have individual stocks, anything can happen with those companies. You may have to go in yourself and rearrange it. So there's certain maybe advantages with that, but conceptually, there's no reason why you should be playing the lottery, gambling on sports, or playing blackjack without having already chosen to invest. So if you like the video, hit like. If you have any questions, again, shoot me an email. And don't forget to hit subscribe. Thank you.